I think you can like win on differentiating. And there's different ways to differentiate. I'll go into a couple. So like one is to be like a first mover, right? And so you're just like, this could be like a thesis, an insight you see.
Right.
Maybe there's some dislocation in the market. It's just like you're first there. It's like why hedge funds should and could exist.
So hi everybody, I'm Tetsuro from Off Topic. I'm here today with Winter Mead from Coolwater Capital. He's currently here in Tokyo. Winter, thanks for coming.
Thanks for having me.
And let us know why you are here in Tokyo, Japan right now.
Yeah, thanks everyone for listening. So we are launching the Coolwater Capital Accelerator Program. We are helping both build new emerging managers as well as accelerate existing emerging managers in venture capital. And we're doing that locally in Tokyo.
And you've done this kind of all over the world, right? Starting in the US.
We've done it mainly in the US. So we've helped over 250 funds accelerate in the US, and they've raised approximately $4 billion since graduating, USD. And that's significant, right? That's over the last 4 years. So that's about $1 billion raised per year across like the cohort. So these are very high quality managers. They come from great backgrounds, their experience. They work at technology companies. They work at corporates. You know, they work at existing venture capital firms, you know, for 5, 10, 15 years. And then they're, you know, ready to hang their own shingle, set up their own investment firm. And so a lot of those high quality firms come through Coolwater the same way, like if you're a very skilled entrepreneur who's starting your business and you're early, you may go through Y Combinator in the US. But instead of us working directly with technology companies, we work directly with fund managers, investors, right? And so we're referred to as the Y Combinator for funds. Right? Because like we are a similar model, like an incubator accelerator.
Got it.
But we're more focused on helping build and co-build investment firms versus technology companies.
Right. And then do you know, Coolwater does a fund to fund as well. So you guys invest in not all, but some of the funds that either go through your cohort or maybe some that don't. Is that correct?
So the model in the US is threefold. So we just mentioned the incubator and accelerator. So, you know, every, call it 3 to 6 months, we're running an accelerator with, you know, 20 to 30 funds.
Got it.
We meet with thousands of teams and individuals that are looking to raise a fund every year in the US, and we kind of winnow that down again to, you know, 5% of our applicants.
Right.
That's like the curated group, the curated cohort that we kind of run through the accelerator every 3 to 6 months. So that's the first thing we do. We also run a fractional CFO business. So like we think back office is really important, especially, you know, as you start to scale and you take on institutional capital, like running a really buttoned up back office is very important. Right. And so we originally, you know, 3 years ago started doing that as a training program as well. So we did that in person. We only did it in San Francisco and New York, but like we'd fly to New York or be in San Francisco. And we would be working to kind of help the managers, looking over their shoulder, actually help them set up the business processes, like the implementation, the workshopping, right? So, but that has turned into, right, like you want to invest, you're a fund manager.
Right.
At some point, you're not going to become the CFO. That's not going to be your full-time job, but it's very important. And as you scale, right, there's expectations increase. Like investors want more reporting, they want better data. They want you to audit your, you know, firm. They want like, you know, accurate valuations. And so that's kind of the second piece. It's complementary. Like the first piece is existential. Let us help you understand what it means to be a fund manager. Let us help you understand what it means to be the CEO of your own firm. Right. Let us help you kind of get off the ground and kind of put all those pieces together so you can like launch your firm and like, you know, get some solid footing. And the second piece is like, great, you've done that. Now you actually have to implement some business processes and become more efficient. So, so like you're not tripping up over stuff and spending all of your time putting out fires, but you're actually like spending all of your time finding the next best deal.
Got it. So it's the 0 to 1 part, but also the 1 to 10, 10 to 100 part as well.
Yeah. So those are the first two things. And then, you know, we also, selectively invest into managers we're very excited about. And again, we take like a we want to work alongside of you partnership approach to that,
Right.
right? Where we want to be one of the most, if not the most involved LP,
Right.
right? So we frame it as like number one value added LP to the managers in which we're investing.
Right.
Like that's kind of the moniker we want to earn.
Makes sense. Makes sense. And then kind of transitioning, to Japan. Can you talk a little about the Japan cohort? Like, what do you see? Just full disclosure, off topic, and I'm part of the first cohort.
We're very excited about it.
Yeah, we're super excited about it. We haven't started yet. We're about to start the program right after this podcast, in an hour. Yeah, can you talk a little bit about the Japan cohort?
Yeah, so I just mentioned kind of how it works in the U.S. There's three pieces. We are bringing the incubator accelerator to start kind of our kind of partnership with Japan. So we are sitting in Jetro's offices. We have partnered with Jetro. Like their mandate is to increase the number of startups in the Japanese ecosystem, to strengthen the capital markets and the startup ecosystem here locally, and to connect kind of the startups and the fund managers to the U.S. right, to increase that value-added network and that capital network. So that's the first part. Like what we are building here is launching it successfully with these first 17 teams. So yeah, we spent the last few months talking with over 300 people in the ecosystem, kind of winnowing that down to 17 teams that we're really excited about. These are experienced operators. These are experienced investors. These are individuals with track records, individuals with brands, people that have been trained already by some of the best global brands, like companies in the world. And, so we put them together in this cohort model, and that's what we're going to be running kind of locally here over the next, 4 months.
Amazing. And hopefully, you guys will continue to kind of bring it over here, but I guess that's kind of TBD still. Let's talk a little bit about kind of the general kind of VC landscape. And I'm assuming most of this is going to be about the US. I think in the US, you've seen this huge kind of spike in emerging managers, or what we call, I think the general term for emerging managers is until about Fund 3 is kind of
there's different
general
definitions. Yeah, some people define it like if you're a pension fund in the US, you can define an emerging manager as an investor that has less than $1 billion in AUM, which is a significantly sized investment firm.
Right.
But I think for what we're talking about in venture capital, it typically refers to a firm that has less than 100 million USD.
Got it.
In AUM, and it's typically a fund 1 through 3.
Got it.
So once you have an established track record, once you have kind of DPI in the strategy in which you're raising for, and that usually happens around Fund 3 or Fund 4, right? Like your Fund 1 starts performing well,
right?
You sell some companies, you're 7 years into your investment track record, like you have an established limited partner LP base. Your strategy is working, you're starting to make money, you've built a team, that team is solid, that team is stable. Right, then it's like, okay, when do you what is that line? It's a gray line.
Right.
Some people, it's there's no real definition, but it's usually around Fund 3 or Fund 4.
Makes sense. What's kind of the graduation rate in terms of like people who are able to go from Fund 1 to 2 to 3 to what we would generally call like an established manager?
This was a great question. So, to be honest, we haven't looked at the data for the full market. So we can only kind of speak to what has happened in the US in our program over the last 4 years. For the first 4 cohorts, so we are on cohort 11 in the US. For the first 4 cohorts, we had a 100% success rate, right? So that's the first 2 years of the program.
Right.
So it's like Cambridge benchmarks, right? Like they usually don't report on like the prior 2 years.
Right.
So it's like T minus 2, and then everything before that is kind of where they kind of do benchmarking. But we had a 100% success rate. Everyone who came through our program, again, we're curating from like hundreds, but now thousands of teams per year.
Right.
We're trying to say like, hey, this team has something special.
Right.
Right. Like let's bring them in and try to work with them. We can't take full credit for their success, obviously.
Right.
But they have been successful, right? Like we're trying to play a role of best enabler and value-added partner. But yeah, so we have a really high success rate of managers who graduate from our program to actually getting into business.
Right.
That is, again, that's from like years 3 years ago and 4 years ago.
Right.
Right. It's not last year or the year before. If you look at it like everyone, like so if you actually include like last year and the year before, we have an 89% success rate. So 9 out of 10 of the funds that have like again come through our program and have graduated. This is kind of not including the last, I guess, 6 months because it's just too early.
Right.
Those funds are like just like setting up, their entities. We have a 9 out of 10 of the funds are successful. And then if you look at kind of the graduation rate, which is like part of your question, it's 25% overall. So let's call it, of that cohort 9 and before, about 200 funds that have graduated. 52 of them have raised follow-on funds.
Got it. Okay. So that's fund 2.
And so that's about 25% of the graduates. But again, some of them are still in their first investment periods. They haven't even tried to raise their second fund. And some people take 4 or 5 years to invest their fund. Right. And some people take 1 or 2 years to invest their fund. Makes sense. And so we're not sure how those numbers are going to shake up. Like obviously they're going to go up from 52, but we don't know at what.
And some people might be in the process of raising fund 2 currently.
Yeah. But again, some people want vintage diversification, investing over multiple years versus concentrated in a single year.
Makes sense.
And if you're taking institutional capital, they also recommend kind of diversifying over time, and having a pace of investments. So the 25% have now raised follow-on funds. The graduation rate, if you look at it on like a cohort analysis, again, it's over 50% now from like cohorts 1 through 3. Okay. Right. So 1 out of 2 funds is raising a follow-on fund. So of that 50, right? And so like you can start to break it down there. Right. But we just look at it as that's Coolwater specific numbers. Right. It's like kind of saying like, okay, if you're a Y Combinator, like startup, do you raise follow-on capital? Right. And then what's the rate of people that start businesses in the U.S. to who raises venture dollars? Right. I would say the ratio is higher at YC. Definitely. For have you gone through YC to have you raise venture dollars than if you just start a startup in the U.S., which is literally like hundreds of thousands of startups being started every year. Right. Most of them, like I'm talking like high 90%, like are not getting financed by venture capital firms. Right. But I would say most of the startups in YC are getting financed by venture capital firms. And so I think that's kind of the similarity or the parallel. Like again, we're doing it for funds, they're doing it for companies. But what we're trying to do is, the same thing in Japan, is curate the market. Right? And say like, hey, there's 1,000 people that want to be fund managers, but we just want to work with the 10 or 20 best managers every year. Right. Right. And then of course, because we're doing that level of curation, like the expectation is that 10 or 20 are going to be more successful at raising their first fund. They're going to be successful at raising their second fund and hopefully beyond. Right. And so we expect our numbers to be more, I think, successful relative to the greater market. Right. But I don't have those market numbers. Makes sense. That's my cop-out answer because I don't have the data for the market numbers.
So, me joining the program, obviously in the future, funds that go through the program, they approach different LPs to raise capital. I think a lot of the emerging managers or kind of the younger kind of folks, it's struggle, especially in the current environment. I think especially in the U.S., where a lot of LPs seem to, or institutionals want to invest in more established managers, to bigger funds. What's kind of the argument that I think a lot of emerging managers make in terms of why should you back me versus a big firm like Sequoia or like Benchmark or Andreessen? What's kind of the thesis behind an emerging manager versus
There's a couple of arguments. One argument is you could do both, right? So what is the free lunch in the investment world? Diversification. Right. So do you want to put all your eggs in one basket? Right. Or do you want to diversify across different asset classes and different strategies within the same asset class? So if you consider venture capital an asset class, if you're diversifying within that asset class, within venture capital, you could do both emerging managers and established managers. Right. And maybe you do it as like 80% of your capital goes into established managers and 20% of your capital goes into emerging managers. Right. Now within emerging managers, why, like that 20% of capital, let's say you're putting into emerging managers, right? So you invest $100 million a year, you're putting $20 million a year into emerging managers, and you're putting 80 million into the benchmarks and the Sequoias and the names you just kind of mentioned. So that's another argument, which like you're diversifying there.
Right.
So why would you make a $20 million bet or various bets like across, emerging managers with that $20 million? Well, right, like if you look historically over the last 30 years, the research would indicate that smaller funds outperform. This is driven off of the fact, especially for venture capital, that if you're getting in early and you're thinking about kind of these institutional best practices like portfolio construction, like high ownership within your portfolio, that can generate outsized returns, right? And it requires less market capitalization.
Right.
So in the Japanese market, for example, where you have a lot of exits, like one of the reasons why we think Japan is a compelling market, where you have a lot of M&A and a lot of IPO, right? But they're not outsized in terms of the size, right? But you can generate returns. If you have a smaller fund, right, the market capitalization required to generate a 3x or a 5x emerging manager fund, if it's small, where again, like a market like Japan where there are a lot of exits, you can actually generate outperformance on that small fund. If you had $1 billion fund, right, like an established manager, and you're to say, hey, I've got to generate a $3 billion outcome now. I need to generate $3 billion. That's return to your fund. So if you're $1 billion fund, you're most likely owning like 20%.
Right.
Let's just say like you keep that, right? Like you're amazing and there's no dilution, just for simplicity's sake. That means in order to get a 3x gross fund return, you have to generate $15 billion worth of value at the market capitalization level, right? For a single fund, right? So what does that mean, right? How many companies? There's 10 companies, right, that are probably privately listed, maybe, that are over like $50 billion, right? And then you're kind of saying like you're going to generate 15 billion just for your one fund, to generate a 3x return. So that's the argument of like why smaller funds are more interesting sometimes than bigger funds. The other kind of argument that, or another argument that's made, I could go on for a while here, but I think another argument is just like emerging managers represent something specialist, right? So they're really good at something, and that means founders want to work with them. Right. And so it's not like the best founders skip over emerging managers. Because, like, don't get me wrong, like the best founders want to work with the established funds. They like the brands. The brands open up like a lot of kind of channels and avenues for them. But emerging managers, if they're good, right? And again, Coolwater just wants to work with the best emerging managers, right? That's why we're doing so much curation up front. We're not working with everyone. That's like not the game. The game is like only work with the best. So if you're working with the best, then like founders want to, like high quality founder talent wants to work with high quality. Right. And they want people that are involved, and they want people, again, that open up doors because of their specialist expertise or their specialist network or their ability to like, help build brand for that startup or get distribution, marketing distribution for that startup. Or they can do like, business development for that startup because of, their connections. There's a lot of reasons why emerging managers are like very interesting from like as a founder, like, if founders have choice of who to pick, who to work with, we want to work with great investors, great GPs, general partners of the fund, so that founders, like, if I were a founder on the other side of the table, I'd be like, I want to partner with you because you can help me get distribution. Because like you bring everyone in the Japanese market onto your podcast, and you like, you can connect me with them easily, right? Because like you're an instrumental player in the local ecosystem, and therefore like I don't have to worry about connecting with anyone. Like I can just, go to Tetsuro and he's going to like connect me to like anyone that's anyone like in the local ecosystem. And like, great, that's taken care of. I know why you get onto a cap table. Right. And emerging managers represent that kind of specialist ability.
I think you also made really, really important point where, Coolwater only works with essentially the best. Right. And I think that part is extremely important, because I think if you take on average, I think, emerging managers, they tend to perform about as well, maybe if not a little worse than established managers, but the top performers tend to outperform the top performing established funds. So I think there's a big difference there, and I think the strategy I think you mentioned where you don't invest in everybody, right? You really curate is actually like extremely important when you're going after emerging managers. So for example, like off topic, we would be, obviously, focus. We would have kind of a media angle as well, where we run a podcast. I think what do you think in terms of differentiation in on this side? Because I think obviously most recently Harry Stebbings from 20 VC has raised a $400 million fund. My personal belief is that media alone isn't a big enough differentiation factor, just because a lot of VCs are now starting blogs, they're starting to have a big Twitter presence. There's some distribution they can get. And so what do you think, is this an interesting angle for Coolwater? What have you kind of seen in the market that kind of works well and doesn't work well in kind of the media times?
Yeah. So what's a framework to think about it? So I guess for the listeners, like if you're a public market investor, right? What are you? You are a stock picker, right? And unless you're like a massive player, you usually can like pick stocks and then invest in those stocks.
Right.
And then it just comes down to like how good at stock picking are you? But venture is different, right? The private markets is different because you can pick a stock, but you might not have access to that stock, right? You can't just like buy it on a public market.
Right.
I think that's kind of what we're talking about here, which is like there's kind of two parts in venture capital. There's one part in public equities. Like the one part in public equities is you're a stock picker. The two parts in the venture capital world is like you have to pick the stock, right? So that's investor discretion. Right? That's perspective born by experience, right? Like what do you know about the venture model, hyper growth, how businesses grow, how businesses are built, why they're successful. That's investor discretion. Like you have to pick, but then you also have to win, right? And I think that winning part is what you're talking about, which is like, like what's differentiated? Why do you win?
Right.
And I think that you don't really differentiate on investor discretion. It's like you can iterate on it, like it's something to hone, like it's a skill set that's like refined over time. But I think you can like win on differentiating. And there's different ways to differentiate, right? Like I'll go into a couple. So like one is to be like a first mover, right? And so you're just like, this could be like a thesis, an insight you see. Maybe there's some dislocation in the market. It's just like you're first there. It's like why hedge funds should and could exist. Right? It's like, oh, they see some market dislocation. Let me take advantage of that and kind of like buy into that.
And that could be either like through a specific category, maybe like in the past, maybe like deep tech, right? Maybe like space investments was one thing. Maybe
that's just saying like 5 years ago, like that's like the Uber example. It's like you have geolocation on your phone, and therefore like Uber as an investment makes sense. That's an insight like that a VC made, why they invested into Uber. Right? It's like as a VC, like that's a thesis, like, oh, the technology platforms, or like we're at a shift in time, right? The confluence of different technologies, right? Like, deep tech, like the cross-disciplinary nature of deep tech. Like we're at a point in time where if I bet on these certain companies, like most people aren't thinking about that. That's like a 3 to 5 year kind of ahead of time type bet. Like it's Gen AI 5 years ago or something, right? Or 7 or 8 years ago, right? Like where there were people talking about that and like what it was going to be, and investing into that, right? Those early LLMs or whatever, and like that was avant-garde. That was like next. So you can differentiate best on that, but that's not persistent over time. Like you can't like defend that, or that's not necessarily going to like stick around for 10 years, like a decade. So then it's like, okay, what are you differentiating on? You could differentiate on like strategy, right? Like so strategy is more like like how you capture, I guess, that ability to win, right? And that could, for you, it's like media, right? But for others, it could be, it could be more explicitly like you worked at the top, business in the last 5 years as like the CTO. That business like grew from like only you as the first engineer to like 1,000 engineers, and that is like the most aggressive, successful company with like very ambitious employees that also want to spin out. You know, there's tons of spin outs per year. And like because you hired every single person and you know their ability exceptionally well, right? Like that's an advantage. Like other people don't know that.
Right.
Right. Like, so maybe you're spinning out of like, you're the CTO at SpaceX.
Right.
Right. And like anyone who's starting a rocket company, like if you care about that space, like, again, like that's something other people can't replicate. Like they haven't gone through that kind of journey. So that could be like a way to kind of differentiate on strategy, like based on like your network. So there's different ways like you can, I think, differentiate it, but you know, there's not too much innovation here. You don't want to try to be like too innovative.
Right.
But you want to make sure whatever you're differentiating on is substantive, right? Because you still have to win.
Right.
Like if you just said like, hey, you know what would be great is if I picked up on if I just invested in all the great engineers coming out of SpaceX, but you weren't a rocket scientist,
Right.
you didn't work at SpaceX, and you never angel invested in any space companies, but you had that thesis, right? Like, oh, this would be I think all these, I should just blanket invest across anyone that spins out of SpaceX in the next 5 years for my fund. But you're not going to win, right? Again, like you've picked right? Like maybe you're winning, like you're right on thesis, but you're not actually going to win. You're going to go to that person, they're going to be like, I've never met you in my life, right? But if you're like the CTO at SpaceX, they're like, oh yeah, you were my boss for like 10 years, like you're awesome. Like, yeah, I want to take your money and I know you're going to be super helpful as an advisor. Like that person picks the right thesis and they win. That's what differentiation is.
Got it. And then I guess we're kind of closing in here, but in terms of like Japan, I think Japan historically has had a very different LP base where it tends to be far more corporate oriented versus I think in the US it's more institutionally based. You know, what do you think are some of the pros and cons in terms of managers, you know, VC funds raising here versus, you know, differences versus raising in the US?
Yeah. I think in the US, a lot of like the alternatives investing was led by like the endowments, right? Starting probably 30 years ago.
Yale was a great example.
Yeah, like David Swenson, kind of his pioneering portfolio management, like his initial kind of, you can generate outperformance by investing into alternatives. I think kind of a lot of people, and like they're kind of independently operating, financially oriented pools of capital. Right. I think they're kind of again, pioneering portfolio management. They're kind of like the pioneers of that model of portfolio return. Right. So I think in the US, like a lot of people have kind of adopted that model as, okay, here's how you make money here's how you make money in alternatives. Right. And in Japan, I think you're right. There's just a different composition of who's actually supporting the investment ecosystem and why, right? And I do think that's starting to change, which is why like Coolwater's excited to partner with the market. But I think for a long time, and maybe this is still going on somewhat, there's an interest in like strategic return versus financial return.
Yep, I think so.
Right, and so for corporates investing into the market in venture capital, because that's like the point of this podcast, like. For corporates investing in venture capital, they might be looking for more strategic return. Right. And that's true in the US as well, right? That's just one type of LP. Right. So if like the person that is, and that's fine because it grows the ecosystem if you have someone investing into venture capital. Right. But again, like if you have kind of the pioneer, like who's again supporting the growth of the venture ecosystem, like in the growth of kind of institutional managers, like it was endowments. Right. In the U.S. And I think corporates, they can play a really key role, like sponsoring and investing into emerging managers, established managers, and they may still have like a strategic angle to that, and that's not necessarily a bad thing, right? Like that's their mandate and what they're trying to accomplish. But I think like one perspective or another perspective is just like to think about the different, call it constituents, or the different archetypes of LPs, right? And who are you speaking to when like you're fundraising? Right. And if you're you're historically used to only kind of pitching corporates and that is like a easier way to get capital, right? Then you're kind of missing out on talking to pensions, talking to banks, talking to insurance companies, talking to endowments, talking to foundations, talking to family offices, talking to OCIOs, talking to multifamily offices, talking to like high net worths, right? Like there's a bunch of different archetypes
Right.
of LP that like I think that's where we see the opportunity, which is like
Interesting.
right now it's kind of ad hoc. Like yes, corporate is the biggest, but it's like there might be a family office here or there
Right.
that kind of like also kind of helps jumpstart a VC, or
Right.
maybe there's like a family connection or something that kind of gets them off the ground. But it's like, how do you institutionalize like understanding what different LP archetypes are,
Right.
and what is a fundraising strategy for actually diversifying your LP base? Where it's like, oh, historically we just raise from corporates, so we'll go to corporates and that's how it's done.
Right.
Versus like, let me take a step back. Like, what is fundraising?
Right.
What is fundraising strategy? As my fund for my strategy, like my investment strategy, what is my fundraising strategy based on my investment strategy, based on what I'm doing, right? And maybe it's better for you at some point to like go after financially oriented investors to diversify that base, and maybe you have the performance and the numbers to do that.
Right.
Or like maybe you start out as corporate, but
Right.
then like by fund 2 or 3, you start to diversify that LP base.
Makes sense.
Right? So it doesn't mean like you even need to change kind of taking capital from corporates. It's just like broadening a perspective to kind of say like, if I want to persist for 5 or 10 funds,
Right.
my LP composition needs to change, and I need to understand what that looks like now so that I can prepare for the future.
Makes
It's
sense.
the same thing with like how we teach back office. It's like, we don't say build an institutional back office from day one. That's bad advice. It's like, what are the things you need to do now? Right? Like I wrote a book in the US called How to Set Up a Venture Capital Fund. I wrote another book called How to Raise a Venture Capital Fund. But I wrote How to Raise a Venture Capital Fund first because I believe like you need to raise the capital
Right.
and then you need to set up the fund,
Right.
which is counterintuitive, right? You don't need to set up the fund before you raise it because you don't have anything to set up,
Right.
right? You need to raise the fund, and once you have the capital, then you
Right.
start setting up the business processes. And it's the same thing like where on the operational side, we want to help the managers think through, what do you do now to be successful? And that's not everything at once. And on the fundraising side, it's very similar. It's like, you don't approach all those LPs at once. Like there's okay, friends and family. Like it's the same thing raising a company, friends and family round.
Right.
Okay, that worked. Maybe you go to seed investors. Okay, that worked. I hit my milestones. You go to a bigger fund. Okay, maybe Series A. It's like the same thing when you're raising for a fund, friends and family. Great, I got to a first close. These are my early believers. Okay, I worked at that company and we made a lot of money together. Let me go to like those people and kind of, outside, like they kind of know who you are, they know your brand. Okay, great. Like now I've expanded kind of a greater friends and family round. Okay, great. I got to my second close. Now it's like, okay, I have some momentum here. I've got my first few companies. There's some traction. Let me go to people that maybe are like fund to funds,
Right.
or endowments,
Right.
or family offices, right? People that like venture.
Right.
They want to co-invest with you, or they view you as like, again, a really interesting kind of asset in the ecosystem. So then you go to them, you kind of raise from them. Like, okay, great. Now you're a little bit bigger. Right, but you're not going to go like straight to a sovereign wealth fund or a pension fund
Right.
before you go to friends and family.
Right.
There's like an order of operations, and so I think that's how we think about it. Like where in Japan there are certain dynamics, but we don't view that as like a problem or even something you need to change. You just have to recognize it and be able to like understand how it works and
Right.
how to like manage around it.
Makes sense. Makes sense. And then if any kind of managers have questions about the program, or if in the future you guys are interested in doing another program here, what's kind of the best way to kind of reach out? And,
Yeah, just find me on LinkedIn, right? Feel free to connect with me, write me a message. Ideally, if you connect, like write a note, tell me like why you're connecting and that you heard this podcast.
That is very important. I cannot stress that enough to add in a note.
I get like hundreds of LinkedIn requests a month, so it is kind of tough to respond to everyone if there's not like a note. I'm not sure like what the context is. There's a lot of people scaling HR software that I get hit up on.
Makes sense. Winter, it was great chatting. I mean, ideally, like we can chat again when the program ends and see if I've developed any skill sets. But hopefully we'll keep growing. And thank you for letting us in the program. And we're excited to get started.
Yeah. Thank you so much. Thanks.